to a really great financial future. Tom and Don are talking real money.
The human condition. We have our little quirks and foibles, don't we? And when it comes to money, we have a couple of big ones. We worry about, well, a lot of things, but particularly things like, and silly things, like taxes or hedging against inflation. We're always trying to find something to magically transform our portfolios into something that will never go down and always go up. We want magical stuff. We do, and we're not going to get it, and that's why we're here to help you. We could say you could get magical stuff, and we would probably have a much bigger audience, but we refuse to lie to you, pander to you. This is the non-pandering Talking Real Money podcast with your host, me, Don McDonald, and your other host, Tom Cock. Hi, Tom.
Hey, you know what? Here's the thing about, I guess, we're still not getting paid by Avantis or Dimensional either, right?
No.
Okay,
Hold on. Let me check my bank account and see if they surprise me with a little transfer.
Yeah.
Nothing from Avantis or Dimensional, or even indirectly through their buddies.
No, I know. I heard you talking about it again the other day. And
because people keep thinking we're on the take. Why do people think we're on the take? Because we're suspicious by nature, and That's don't
true.
blame us because, I'm sorry, but most people in this industry are slightly crooked. Slightly.
Yeah. Okay, but you raised an interesting topic, one of which is, I think, way too much time and energy is spent on, and that is inflation. The fact that things cost more tomorrow than they did today. That's been a factor for, 3,000 years, basically, right?
Yes.
Yeah.
Okay,
like
I'll
that.
give you 3,000 years. Yes.
Okay.
I'll give you two. I don't have data going back that previous 1,000, but I can get data going back to Julius Caesar's time. Roughly.
Yeah, I just watched a series on Rome, as you know, because I'm headed there this summer. But here's the thing.
Oh, you're roaming?
I'm roaming.
Again?
That's good. I like that. Inflation now, if the government is to be believed,
Yeah.
right? And there's
people,
argument
and people
about that.
Yeah, I know.
Argument about that is running at 3.8%, which is, and I know this is going to be unbelievably shocking, the highest rate of increase in over 3 years.
Over 3 years.
Oh,
We're not short-sighted, are we? No.
Which to you and I seems like 15 minutes ago. Sometimes somebody's saying something about 2050. I'm like, yeah, I don't remember because it was literally like yesterday.
Well, at our age, they're gerbil years.
Yeah,
not even dog years. They're gerbil years.
But there's a lot of whining and complaining. Gas is up 28% year over year. Wages are up 3.6%. Food, electricity, and airfares going up a lot.
Because they all rely on fuel.
It turns out. But I guess this is my problem, like a lot of other things. But here's the thing.
I didn't want to say that.
I know.
But since you admitted it, yeah. Mm-hmm.
The Federal Reserve's targets.
Speaking of foibles.
Large. You said large foibles.
Large foibles.
Which kind of hurt my feelings. Speaking of the Fed target is 2%. Look, my target weight is the same as I was in college. That's my target. It ain't going to happen. And 2% is pretty low when you look at, okay, and I know we're going to have a discussion about this. Let me finish. 100-year average, 100 years of data now, 3%. That's been the average.
But that's the average. What about those aberrant periods?
Yeah, okay. So if we could have low inflation if we have a period like what the let's say Great Depression. That would be good. Let's do that again. Well,
that's an aberration.
Okay. Yeah, let's do that again.
I'm pretty sure we had deflation.
Yeah.
Let's see. I got the numbers for you. You ready? In 1930, the inflation rate was -2. In 1931, it was -9.
Wow.
In 1932, it was -10. And in 1933, it was -5.
And you don't want that either. But again, this is my take. A lot of whining and moaning about 3.8, which is, in my lifetime, I've seen a lot higher. And I know my lifetime's been long compared to many of you. I get it. I did ask, by the way, at the all-staff meeting the other day about people driving to work and whether they've been impacted by the much higher gasoline prices. And about half the room said, yeah, they've adjusted their driving. I get which the adjustment is they just don't come here anymore. That's a whole other story.
They haven't come there since COVID.
I've been wandering the halls like, hi.
Even the 4-day-a-week policy. They haven't come in there since COVID.
3 days. 3 days.
Oh, it's 3. Oh,
yeah,
I would bet those 3 days. Let me guess which 3 days those are. 99% of the time.
Yeah,
Let's see.
Guess. You ready?
Tuesday.
Yeah.
Wednesday. And Thursday.
Ooh, you are one bright guy.
And I bet they're working hard at home on Mondays and Fridays.
I just fired a cannon through the hallway. We're recording this on a Monday, and it didn't hit anybody. Just right through, right down the hall.
All right. The reason we're talking about inflation, though, is because we're always, as investors, at least we seem to always be looking for that inflation hedge. I want my tips. I want my real estate. I want my gold, whatever it is that's going to hedge against those things. Or you could go to the company known for magical thinking and magical product building. You know them, you love them, you buy their stuff, advisors love them, they charge a fortune. Yes, ladies and gentlemen, we're talking once again about PIMCO.
Those wacky and wonderful people from Southern California, formerly led by the wacky and wonderful Bill Gross, who's spun off into another planetary system. So,
yeah, he did kind of go a little whacked.
Oh, boy, did he ever.
PIMCO has a relatively new product. It's called the PIMCO Inflation Response Multi-Asset Fund.
You think some marketing guy would have said that's too many words, but apparently
too many words. Or a symbol you'll never remember, PZRMX. Now, this is a fund that tries to be all things to all people who fear inflation. They go long, they go short, they go tips, they go real estate, they go futures contracts, they just go flipping crazy. And what do they charge you for that? Well, their gross expense ratio is almost 2.3%. Now, they got to overcome inflation by a big margin to make up for that.
So 230 basis points.
You're doing it again just to make people mad, aren't you?
Because I just like to compare that to, like, you could go get BND for, was it like 3 basis points? A lot cheaper,
230
folks.
to 3. Oh, and by the way, the one that you're going to get sold by your broker is the Class A share.
Oh, so it includes?
A 5.5% reduction in your investment for the commission to the person selling you the product. So right off the bat, you give up $5,500 on $100,000 right off the bat.
Yeah, when you look at this fund, you not just the cost, but you look at the makeup of it, you look at what they're trying to do. You really need to bring Al Michaels back in and have him say, do you believe in miracles? Because the reality is, and by the way, tips, if you think they're going to rescue, in short term they can, but remember, I just saw this in the piece. Schwab's U.S. Tips Exchange Traded Fund lost 12% in the highly inflationary 2022. So it doesn't always, tips don't always give you that protection. But in the short, this is what I'm getting at. In the short term, the idea that you could use tips, I guess you could use I-bonds, right? Even though they're only paying 4.26 now, or commodities, gold. In the short term, that's going to somehow protect you from higher than expected, unanticipated, unloved inflation. I think it's silly. And this fund, silly isn't even the right word.
And the turnover, I got to tell you all the downsides. Okay, one, leverage. They're borrowing money. They're using derivative securities. We've talked for years, decades, about the dangers of derivatives and how much people love them right up until the derivatives stopped working the way the people who built the derivatives thought the derivatives were supposed to work. It was hard to say. They're in commodities, which go all over the bloody place. By the way, they buy their commodities through their Cayman Islands subsidiary.
Oh, yeah. Well, that makes
which
sense.
is unregulated. They have high expenses, and their turnover, this is the number of times they turn over a portfolio. If you have a portfolio that has 100% turnover, you basically sell the equivalent of everything in the portfolio every year and buy something new. That's 100%.
Yeah.
Theirs is 322%. Three
They're
times
busy.
a year.
They're working hard for you, for the money.
They're working hard for their 2.3%.
Exactly.
But here's the problem. Remember how I proved that every year doesn't have inflation earlier in the podcast?
Yeah.
You know, if we ever have a period like the Great Depression again, where we have falling prices, this thing explodes all over you.
Yeah, because of leverage, because of the bets they've made, et cetera. But again, stepping back, and this is a horrible fund. Let's just be honest.
It's a kind of fund no one should own. No.
Please do not own this. But let's be honest with ourselves that really when it comes to inflation, increasing prices, increasing wages, the best bet, if you will, that you can make for the long haul is stocks. Yeah.
And they're simple and they're cheap.
Yeah. Companies increase prices. So
here's the thing, Tom, and you, listeners, we love you. Here's the thing. We, as I said, we're flawed people at the beginning. We thrive at the extremes. We love living out on the edge. And this Barron's wrote an article about this, and I guarantee you, after the Barron's wrote that article, millions and millions of dollars poured into this thing. They got all this press because people love these extreme products. They're looking for this magic pill that will give you a lot of return on the upside and protect you on the downside. And that's a combination you cannot expect.
Yeah, I would again give the equate it to my weight, but in this case, now we know you can take a pill to get me back to what I weighed in college.
You can.
I'd be wrong there, but no, there's no real pill or placebo that's going to fix your inflationary issues. Let's leave it at that.
Yeah, and if you want to ask about the inflation hedge of the day, that would be the inflation hedge du jour. Give us a little note. Send it to us. Go to talkingrealmoney.com, the new and improved talkingrealmoney.com. For those of you who are asking, please give me the podcast right there on the homepage. You were heard. It's there. And then you can just click on the button that says ask a question and type your question, and then Tom might call you kind of like this.
In Milan, Pennsylvania, we find Chris, who joins us on Talking Real Money. How are you today?
I'm doing well. How are you, Tom?
I'm doing fantastic. Great to have you on the program. Really appreciate you listening and reaching out to us with your question, which is, what would you like to know, sir?
So I'm contemplating on how soon I need to start shifting from a higher stock to bond ratio down to something more conservative. I'm roughly 50 years old, targeting like slowing down some around 59 or so. I'm not saying I'm going to quit working, but I recently, probably 100% stocks up until this year. I did make a shift to like an 80-15, and I'm wondering if I'm still a little too aggressive.
Yeah, it's a great question. Have you ever done one of either two things? Have you ever taken a risk quiz? We have one obviously available on our site. Or have you had a, kind of run a plan to say, here's how much money I need to have saved by X to retire? Have you done any of those things?
Actually, both. So since I've emailed my question in, I took your risk quiz there.
What was your score?
I believe it came back at a 60.
Okay.
And was there a group, maybe 4 or something along those lines?
Yep.
And I want to say, reading through that, it may have recommended that I might be down towards like a 60-40 style bond or stock to bond ratio.
Well, it's possible. But I mean, how did you feel in, the spring of 2020, or how did you feel after 2022? I mean, are these sharper market downturns, did those trouble you at all?
No, I kept investing through them.
Okay. So, I mean, that's a good sign. I mean, and here's the thing. At 50, being in an 80% stocks, 20% bonds, that's very reasonable. The second part of the question that I asked you was like, so have you done any planning? I mean, what rate of return do you need to make on your money to get you to where you want to be by, let's just say 60? Do you have any idea there?
So I've done a little of that, like on some calculators and things. So probably around a 7% gets me to a comfortable target for that time frame, I'm thinking.
Yeah. So, I mean, an 80-20, obviously any 10-year period could be very idiosyncratic, right? There's a lot of things that can, I mean, it could be 2000 through 2009, right? If you're all invested in the U.S. market, you made basically nothing. So it's very hard to say, but certainly historically making 7% a year from a portfolio of 70% in stocks, 30% in bonds, or 75% stocks, 25% bonds, that has been very doable. Here's the way I might do it, because it doesn't appear to me that you have any aversion to risk. I might start with the 80-20. I might do that for a year. And then again, maybe the beginning of next year, start reducing it a little bit over time. I mean, the real reason to have bonds in your portfolio, yes, is for sort of limiting the bumps, if you will, the ups and downs. But the other part, frankly, is if, let's just say, for example, you did retire at 60 and you needed to start pulling some of this money out, really having it in bonds makes sense because it's a stable pool of money. You could have a down market for several years and you still have money in bonds you could pull from. That's the bigger reason, I think, than sort of portfolio stability. So maybe what you do, Chris, is you start with the 80-20 and then next year, you add 5% more in bonds. So now you're 75-25. You do that over time so that you build up your bond portfolio a little bit more. Maybe it takes a little longer than that because, again, I wouldn't do anything dramatic today. You've already added some fixed income, you see. There's no prescribed. I know target date funds are going to tell you, well, if you're 10 years from retirement, we're going to have you, 60% in stocks, 40% in bonds. There's no right or wrong there. The right or wrong is knowing yourself, and it sounds like you do know yourself, and kind of having an idea of how much money you need to make. If you were working with me and said 7%, I might say, yeah, 75% in stocks, 25% in bonds probably gets you there over the longer haul. Maybe not, the next 1, 2, 3, 4, 5 years, but likely in 10 or around that number. So I kind of like what you're doing here. I mean, the other part would be to make sure that you're globally diversified, that you have small and value stocks in there, that you really do cover all the bases when it comes to diversification. But overall, I think your strategy is pretty good, and I'd sort of stick with it.
Okay, that sounds good. Yeah, so regarding the diversification, I'm currently like my U.S. to foreign would be roughly a 70-30.
Mm-hmm.
And I do have a small cap value fund, and it's about like 25% of the U.S. side of that. So,
yeah.
But do you think that would be too aggressive?
25% in U.S. small cap value out of the U.S. portion? No, I think that's very reasonable. No, I think that's fine. That's a tilt that the academics would probably like because, again, that asset class has been more productive than large growth over the long haul, and you still at 50 have the long haul ahead of you. So no, I think that's very reasonable. I might want a little bit more, international since you're basically 70%. I think you said U.S. 30% international. I might want to wind that out to have a 60-40 or something like that, but that's not a huge change. No, I kind of like all these things you're doing. It sounds pretty good to me.
Excellent. Well, I appreciate the call today.
Well, thank you very much for listening and reaching out to us, and I look forward to the next time we get to chat.
Thank you, Tom.
Thanks, Chris. Take care.
All right, you too.
Or he takes those written questions, which, by the way, are right now in short supply. The trees are rejoicing. If you want to type in a few more questions for Tom, he would be a very happy camper because his pile. Oh, Tom, that you could hardly call that a pile.
No, it's sad. It's like
sparse.
Inflation. It's sad.
So we're going to just be doing like a question now a day?
I've got two for today.
You've got two for today. Oh, good. It is a special day here on Talking Real Money. We're glad you're there. Let me put on my cardigan. Okay, Tom, read your questions. I got my cardigan on.
No, thank you. From Albany, New York.
Albany?
Albany?
You mean Albany?
Albany, yeah. I used to live in Albany, California.
Georgia? There's an Albany,
next
Georgia,
to Berkeley.
Too.
Yeah. Scott writes, hello, gents. Recently heard an argument stating it could make sense to contribute more to traditional 401k as opposed to Roth when you live in a high tax state, in this case, New York, and get much higher than that. Reasoning is as follows. Why pay state income taxes now when I might be living in a no income tax state in retirement? The idea potentially avoid unnecessary double taxation. While I think this generally makes sense, nobody knows what tax rates, federal or state, will look like in 30 years. Thank you, Scott. I can already picture Don getting ready to remind me, don't let the tax tail wag the dog.
Woof, woof.
Which would be really hard for my dog weighs like 100 pounds. That would take a heck of a tail. As for my wife and our household income is around $250,000 a year. We're looking to retire in 25 or 30 years. Upon retirement, I'm anticipating a pension of $100K. So we are heavy towards the Roth in our retirement contributions. I'm curious if the state-based income tax strategy is worth pursuing or if it's overcomplicating a non-problem.
No, I don't think it's overcomplicating. I think we overthink a little, but I have always been a big proponent of both.
Yeah.
Do both. When you are in a high tax situation, let's use situation instead of job, because you're in a high tax situation. You have a great income and you're in a high tax state. In retirement, you might have a slightly lower income and live in a state without taxes. So your situation may be lower taxed. We don't know. It could be higher taxed. We don't know. That's why, since we cannot know the future, we can try to overthink and outthink every possible scenario, but the reality is we cannot know. Get over this thing where you think, well, I'm definitely going to be in a lower, higher tax bracket in the future. You don't know what you're going to be in the future. You have no flipping idea. Stop it. Just do the 401k at work, for example, with the
Traditional.
The traditional.
Yeah.
Do your other contributions into the Roth. Do your company match into the traditional or something. Whatever. Find a way to make both work for you. However you do it, it doesn't have to be complicated. And then you'll have different pots from which to draw in retirement. And you know what? Taxes are part of the price we pay for living in this country or pretty much any other. I mean, does any country not tax?
Wow.
I can't.
That's
imagine.
a good question.
Well, let's find out.
I know the U.S. had trouble at the beginning collecting taxes, but now.
Well, that's because everybody just kind of lived out in the woods.
I'm with you there. I think we should split the baby. I think I've always said this, especially 25 to 30 years, you kind of buried the lead for me. I think having money in different pots is going to be a great thing in your retirement, because depending on the tax situation, you could take a little bit from here, right? You could take some from the traditional, you could take some from the Roth, you could take some from the brokerage, and sort of game the tax system, whatever it may be at that time. So, I think that makes a ton of sense.
By the way, there are a few countries that do not have a personal income tax. You ready for your
I'm going to be moving
home?
soon, standing by.
Okay, your future home?
Okay.
Bermuda.
I could live with Bermuda, I think.
You could be a pirate. Cayman Islands.
Okay with that, too.
Bahamas, another pirate haven.
No problem.
There's only one European country on the list. One.
It's going to be something obscure.
Monaco.
I could live with that, too.
Which is kind of like a city-state. And then, of course, there's a reason for the next six. Saudi Arabia, Oman, Kuwait,
Qatar.
Bahrain, Qatar, UAE.
Yeah.
Wonder why they don't have any personal income tax.
What is it called? Gasoline and natural gas and all the rest of the stuff. Yeah. You, if you are born in Qatar, I told you this one after I visited there now almost 4 years ago. You are set. Your education is set. Your health care is set. Guess what? Energy is set. You don't have to pay for any of those things. It's a pretty good deal. There are not very many native Qatarians, but the people who are, it's a pretty good deal.
Handful. They're just like,
Anyway,
there you go. New obscure fact on Talking
all right,
Real Money.
well,
now to our next question.
It's going to get more obscure.
This is the last one.
Yeah, thank goodness. From Rochester, Minnesota, John writes on the May 13th.
New York.
What's that? Yes, there's a Rochester, New York. This is Minnesota, it says. On the May 13th episode, there was a question about the taxation of VT versus DFAW. VT being Vanguard's total global stock portfolio, DFAW being dimensionals. Oh, God, we're going to get more comments about
this must be about foreign credits.
Yeah, VT.
Oh, nobody cares about foreign credits. They're small.
let's see. The foreign taxes paid by the fund are included as taxable dividends on the 1099. So the fund is essentially paying those on your behalf. If the fund is mostly foreign, then they can provide that information on the 1099, and you can claim a foreign tax credit. How much? I mean, how much are we talking here? It's pretty small. Since VT is mostly U.S., the foreign tax they paid for you can't be recovered. I think you misunderstood what the question was getting at. For foreign funds, the fund will pay the foreign taxes. That reduces your return. For VT, I don't think they can put the foreign tax paid on your 1099 because the composition is mostly U.S. I always forget it's a small number. It comes up a little bit from time to time about foreign taxes and paying them and writing them off, et cetera. I don't think there's a reason to own one fund over another, though. I'll put it that way.
Yeah, and here's the deal. I mean, it depends on the country. It depends on the kind of portfolio you have. But if you have it's only on dividends. It's got to be a foreign fund, basically. Okay. It depends on the country. It's not a very big tax. It's somewhere between 5 and 15% generally on the dividends.
On the dividends.
The dividends. So this is we get all caught up in minutia because of our stupid big brains that won't shut up. A typical international ETF with a, say, 10% withholding tax on dividends, 10%, right in the middle.
Yep.
Reduces your return
by
3%. That's a 3% ETF. That's 0.3%.
Yeah. 0.3 of 1%?
Yeah. Yeah. So if it's a 10% return, you're at 9.7 now.
Yeah. You'll be okay.
But that's in a totally foreign fund. So now you can file the foreign tax credit and get that back. So let's assume you have a fund that's 50-50, which none of them are. I wish they were, but none of them are. Same rules apply. 3% international dividends, 10% tax. You're reducing your return by 1.5%. 1.5% a year. 0.15.
0.15, not 1.5.
1.5. That's 1.5%.
Okay.
0.15. Yeah, 1.5%. Not enough. Now, you're reducing, 0.15. You're absolutely right.
Yeah.
0.15%.
Yeah. 15
basis points there.
Yes.
This is why basis points are better.
It's easier to illustrate.
Yeah.
Again, not a big deal and not something to worry about. You should still have international stocks that may pay you dividends.
Yeah.
Yeah.
Because it's not going to, we generally buy stocks for growth, folks. That's what they're for. Okay. If they pay dividends, gravy. If you pay a little taxes on the dividends, okay. It reduces your return tiny bit. Just get over it. Oh, all right. But don't get over our show. Keep listening. As we say the same things over and over and over again.
Hey, you don't go to church once.
Let me tell you a little milestone we just crossed. And this doesn't include the lost episodes of the past. I don't know where those went.
The lost episodes. Is that going to be?
The early ones, the ones we did back in the 20-teens, the early 20-teens, I don't know where they went. They're gone.
No.
They're gone.
We need Leonard Nimoy to come out and find the lost episodes.
Because I keep changing computer. I probably have them on a hard drive somewhere, but I have a stack of like 30 hard drives.
That makes me sad.
No, they were from the old days. We got them going back to 20. On our podcast service now,
yes.
We just crossed 1,900 podcasts that you can listen to now.
Good Lord. There have been people who listen to every one. God bless them.
Few
and it's not my mom because she's been dead for a long time.
Oh, before we go, it was great. Went to a friend's house to have. We haven't been to their house in a couple of years because they've been just massively busy. She's a new investment advisor.
Oh,
she used to work for Vanguard, and then she's put up her own shingle.
And how's it going?
Well, slow, but it's one solo practice. We went into the house and they said, "We listen to your podcast all the time.
Oh,
we listen to it when we drive. We just love it." Because she feels like she gets great advice to help her build a practice.
Get going. Oh, I love that.
So, yeah. They really like it.
I wish we could help her more, but can't.
No,
really
we compete against her. We can't help her.
I know, but good for her.
Well, Debbie might go to work for her or something. Maybe.
Debbie would be excellent there.
Yeah, I know. Yeah. She would be good. Anyway, thanks for listening. Please go to TalkingRealMoney.com, the new and improved TalkingRealMoney.com, and ask your questions. Or if you'd like, right there at the top row, it says Meet an Advisor. What does that do? That allows you to meet an advisor, one of our 100% fiduciary advisors at Appella. No cost, no obligation. We don't require you to even bring in a pound cake. No high-pressure sales pitch. That's a promise we've been making for a long time because we want you to get this right. And to get it right, we believe it requires us sitting around almost every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.